Today we were going to be diving into ONEQ, which is a Fidelity Nasdaq Composite ETF fund. Welcome to the world of ONEQ, the Fidelity Nasdaq Composite Index Tracking Stock ETF. This innovative exchange-traded fund offers investors the opportunity to gain exposure to the entire Nasdaq Composite Index, providing a comprehensive view of the performance of the U.S. stock market. With ONEQ, investors can access a diverse portfolio of technology, healthcare, consumer discretionary, and other sectors represented in the Nasdaq Composite, all in one convenient investment vehicle. Whether you're seeking broad market exposure or targeting specific sectors within the index, ONEQ offers a flexible and efficient way to invest in the dynamic Nasdaq Composite. With ONEQ, investors can access a diverse portfolio of technology, healthcare, consumer discretionary, and other sectors represented in the Nasdaq Composite, all in one convenient investment vehicle. Whether you're seeking broad market exposure or targeting specific sectors within the index, ONEQ offers a flexible and efficient way to invest in the dynamic Nasdaq Composite. Remember to subscribe and comment on what funds you would like to see evaluated in the future. But back to ONEQ that provides diversification and upside potential from the largest companies on the exchange. Choosing the right ETF involves considering several factors such as performance, risk, and expenses. Let's dive deeper into these aspects. Performance is a key factor when choosing between ETFs. Let's dive into the performance of three ETFs: Fidelity Nasdaq Composite ETF, Invesco QQQ Trust, and Fidelity MSCI Information Tech ETF. Each of these has shown impressive growth over the investment period, but they each have their unique strengths. Let's start with Fidelity Nasdaq Composite ETF. With an initial balance of $10,000, this ETF has grown to a final balance of $42,785, boasting a compound annual growth rate of 15.37%. Its best year saw a growth of 45.74%, while its worst year saw a decrease of 32.12%. Its Sharpe ratio, a measure of risk-adjusted performance, stands at 0.81, while the Sortino ratio, which measures the downside risk, is 1.32. Moving on to Invesco QQQ Trust, this ETF has grown from an initial balance of $10,000 to a final balance of $54,441. It has a higher compound annual growth rate of 18.14%. Its best year saw a whopping 54.85% growth, while its worst year saw a decrease of 32.58%. It has a Sharpe ratio of 0.93 and a Sortino ratio of 1.56. Lastly, we have Fidelity MSCI Information Tech ETF. Starting with the same initial balance of $10,000, it has grown to a staggering $63,097, with the highest compound annual growth rate of 19.86% among the three. It's certainly an impressive performer. Its best year saw a growth of 53.30%, while its worst year was relatively less painful, with a decrease of 29.59%. It also boasts the highest Sharpe and Sortino ratios, at 0.98 and 1.68 respectively. While all three ETFs have shown impressive growth, their risk and correlation with the market differ. Which one you choose depends on your investment goals and risk tolerance. Now, let's compare ONEQ and QQQ, two ETFs that focus on the Nasdaq 100 index. These ETFs give investors a way to gain broad exposure to this index, but they do have some important differences. Firstly, let's look at the expense ratios. Expense ratios are essentially the cost of owning an ETF. ONEQ has an expense ratio of 0.21%. While QQQ's expense ratio is slightly lower at 0.2%. This might seem like a small difference, but over time this minor discrepancy can eat into your returns. Next, let's consider drawdown risk. Both ONEQ and QQQ have similar maximum drawdowns, which means they have comparable downside risks. This is the largest loss from a peak to a trough that an investment has experienced over a certain period. It's an important factor to consider because it can give you a sense of the risk involved with each ETF. So what does all this mean? Essentially, while ONEQ may offer broader exposure to the Nasdaq market, its slightly higher expense ratio can eat into your returns over time. On the other hand, QQQ, with its lower fees, may provide higher net returns without significantly increasing your downside risk. While ONEQ offers broader exposure, QQQ may provide higher net returns due to its lower fees, but remember, the choice should align with your investment objectives and risk tolerance. How about comparing ONEQ and FTAC? Let's see how they stack up. When evaluating investment options like ONEQ and FTAC, it's essential to take into account various factors such as risk, return, dividend yield, and expense ratio. Let's examine each of these elements. ONEQ and FTAC have similar drawdown risks, meaning the potential for loss is comparable for both. However, when we turn our attention to returns, FTC takes the lead. It offers better returns, meaning your investment has the potential to grow more with FTC. But what about the profitability of your investment, the dividend yield? Here too, FTC outshines ONEQ, offering a higher dividend yield. This indicates that you could potentially earn more income from dividends with FTC. Now let's talk about the expense ratio. This is a fee you pay to the fund manager for managing your investment. A lower expense ratio means you get to keep more of your returns. Once again, FTEC is the clear winner here with a significantly lower expense ratio compared to ONEQ. So how does this all add up for you, the investor? Well, by prioritizing lower expenses and better returns, you could optimize your investment strategy for long-term growth and income generation. Therefore, FTAC may offer better returns and a higher dividend yield at a lower expense ratio, making it a potentially more attractive choice for long-term growth and income generation. So, we've compared different ETFs based on several key factors. We've seen how Fidelity MSCI Information Tech ETF outperformed the others in the long run, while the Fidelity Nasdaq Composite ETF showcased lower volatility. Our head-to-head comparisons revealed that despite their similarities, QQQ and FTSE could offer potentially higher net returns than ONEQ due to their lower expense ratios. Choosing the right ETF requires careful consideration of multiple factors. Remember to subscribe, and if a comment for what fund you would like me to evaluate next. Always align your choice with your investment goals and risk tolerance. Happy investing!